Saturday, February 28th, 1:45 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Since we finished the month of February, markets close. There's more than one market. There's a Treasury market, the stock market, commodities market, currency markets. Well, I'm going to go over the U.S. Treasury markets. That's one of several federal agencies that sell U.S. Treasuries, fixed income products you could invest in. It's the largest financial institution that does fixed income products. You could be a civilian, you could be a government, nation from abroad business. Many participate in buying U.S. Treasuries, different durations. They want to have the flexibility of parking money, a lot of money, millions of dollars that typically won't be assured with your regular bank buying CDs or even a money market. Again, U.S. Treasury Department has the best liquidity and a large variety of financial assets one could purchase. It's free. You could create an account. That being said, the Federal Reserve is a different federal agency than the U.S. Treasury Department. Some people get them confused. They have two different policies that have been implemented by Congress. So again, Federal Reserve, they control the short-term overnight interest rate between financial institutions, while the U.S. Treasury sells securities to raise capital because the United States government doesn't collect enough tax revenue, and the U.S. government spends more money than they take in. These U.S. Treasury yields fluctuate. They have financial assets that are auctioned off. They may need to raise, say, next Wednesday, they need to raise, let's say, $100 million. So maybe they're auctioning off 10-year U.S. Treasuries, and they set a yield on those to entice people who want to invest in it. When the yields go lower, interest rates go lower. Got it? Mortgages, credit cards, savings account. When the yields go lower, interest rates go lower. When the yields go higher, the U.S. is paying more on its debt, on the treasuries that are being sold. So if you buy a 30-year U.S. Treasury, well, you'll be locked in for 30 years on that financial instrument that you bought. If you're in the United States and looking to park money for short-term flexibility, I recommend you do the consideration dollar cost average on the 1-year U.S. Treasuries. Again, the dollar amount could vary. You decide how much you want to put in there. Again, if you could afford to buy the minimum, maybe once a month, buy a 12-month one. So every 12 months, you're going to have 12, but every month, that 12-month one's going to expire, and you can either cash it out or reinvest it. Much more secure than your financial institution, banks, credit unions, or your mortgage company. Or your brokerage company, because some people buy fixed income products from their brokers also. Again, there's corporate ones, municipality. Unfortunately, when the U.S. policies, foreign domestic, debt, spending, again, policies have an impact on what these values are in these yields to encourage people to want to buy. So I'm going to show you charts, 4 charts, and then we're going to go directly to the official website so you can see too. These 4 charts are the main, most popular, you could say. Here's Treasuries. This is a chart of 20 years. Each candle is a month. This is the 30-year yield. Again, if you bought it Monday, if you buy it Friday, those yields fluctuate. This chart is just to show you the range. So the past 20 years, here's the low. Again, low yields, lower interest rates. That was back in the year 2020. And then on the top left, 2007, 2004, those were higher yields, higher interest rates for the 30-year. So typically you expect the longer duration, 10, 15, 20, 30 yields to be higher and the shorter term ones to be lower. Doesn't always happen like that. So currently for the year, look what's happened here. Yep, big move down. We broke the low of last month. Big bearish candle. That's on the 30-year. The 10-year, also big bearish candle, but in this wedge. Okay, huge wedge. That's the 10. 30. We haven't gone too far. Look at that. We're still in this range. Above the 24, above the 2024, above 2025. Yep. Same with the 10-year. Now let's go to the shorter duration. The 5-year. Again, a huge consolidation past several years here. For the month, huge red candle. And the real short-term one, 2-year one. Yep. What happened here was this month, we broke the low of last year. Let's remove that. Yep. So lower low, lower high. So just zooming in each of these on these monthly. Top left, the 30-year. Yeah, we're still above the lows of 2025. The 10-year, we're still above the lows of last year. The 5-year, we're still above the lows of last year. And the 2-year, I showed you we broke the low of last year. So the shorter duration one, the yields are declining faster than the higher duration. Makes sense. So if you want to tie up money for longer duration, opportunity to earn more. Let's go to the website now. This is the U.S. Treasury website, official one, .gov. You see several columns. There are many durations you could invest in. Blue column, top, 1 month, 1.5 month, 2 month, 3 months, 6 month, 1 year, 5 year, 7 year, 10, 20, 30. Got it? From the left, the shorter duration, to the far right, the higher duration. Again, U.S. Treasury Department has regular trading hours. They're closed today. Well, let me update this, because again, this was February, part of January. Let's go to there we go, the 27th now. The 27th, Friday's close, yesterday. So look at the 1 month since February 9th till February 27th. Not a big difference. 372, 374. Let's go to the 6 month. February 9th, 359, 360. Not a big difference. Go to the 5 year, 375, 351. Big difference. Big difference. February 9th to the close of yesterday, the 5 year yields have gone lower. You earn less money if you bought Friday versus prior weeks. Let's go to the 10 year. February 9th, the 10 year auction off 4.22. And Friday, wow, 3.97. Again, the 10 year is declining. And the 30 year, 4.95, 4.64 close. So you see the longer durations are declining. Lower yields, lower interest rates, earning less money on fixed income products here. If you buy them for U.S. Treasury, you could go around shop. You go shop for bonds from India, from Germany, Brazil, government bonds, corporate bonds, McDonald's, Verizon. Just give me examples. Yep. How stable are those investment bonds? Remember Greece, those bonds? Wow. Let's go on to the next. Again, yields, interest rates. U.S. mortgage rates. 30-year fixed mortgage rate. 5.98. And the 15 fixed rate, 5.44. Look on the right. Again, this was the close on the average of the past days. For the first time in 3.5 years, the 30-year fixed rate mortgage dropped into the 5% range. That's a good thing, falling even lower than last week's milestone. The 15-year mortgage rate averaged 5.44, up from last week when it averaged 5.35. So let me do this again. The 30-year fixed mortgage rate averaged 5.98 as of February 26th, down from last week when it averaged 6.01. That's good. But the 15-year rate mortgage went up when it averaged back here 5.35, up 5.44. Again, shorter term mortgage, you pay off your debt liability faster. This is just part of the business of mortgages. Remember, there's different mortgages depending what you qualify for. FHA, conventional, VA, private, totally private sectors that are really outrageous. Let's go to credit cards now. The average credit card the average credit card interest rate is 19.59, down from a record high of 20.79 set on August 2024. Really? That's bloody high. That's terrible still. So the national average credit card closed on the 25th, 19.59. That's a big interest rate. That's a lot of debt. Terrible. Pawn shops must be banking very well. Yeah. And I often say the Russell 2000 stock index, those companies borrow a lot of money. They carry a lot of debt. Higher interest rates, they're impacted. Thank you as always, spending just a little time with me. That's it for the video. Thanks for watching.